Hello everybody, and here is Chapter 15, Short-Term Business Decisions. Sorry for the raspy voice here, I'll try to get through without too many coughing fits. So in Chapter 25 we're talking about short-term decisions, and then in 26 we do long-term decisions. So all through the process of accounting we've been gathering all this information, and so now we want to use this, and you're going to see we're going to use some of the things that we that we did in Chapter 21 are going to come back here. The key really to good decision making is to separate out the relevant information from the irrelevant information. Which sounds good, but that's not how most of us do it. If it's about future information, future cash flows, future sales or costs or anything like that, then it's relevant. So expected future data. And we'll mostly talk about cash flows. If it happened in the past, it's what we call a sunk cost, and it's not relevant. What I paid for the piece of equipment is not relevant to my decision. I'm always looking forward, okay? So I have two or more alternatives ahead of me, and I want to see how those, what's going to change if I pick these different alternatives. If it's something that already happened in the past, it's not going to change no matter which of these alternatives I pick. So that it's not relevant to our decision. That brings us kind of to the other one. If it differs among my alternatives, then it's relevant. If it does not differ, it's not relevant to my decision. And sometimes these are, because you think, well, that's a really important cost, or that was a really big expenditure, but it's still not relevant to this decision because it's not going to change either way. I just want to see what's going to change among choice A or choice B. We also have to factor in qualitative data as well as quantitative. And a lot of these questions we focus on the quantitative, but sometimes these qualitative things are just as much. So we'll work those in as we go. Here's a quick problem. These are in the demo problems. Just so you kind of see, you're thinking about buying or trading in your inkjet printer. I don't know anybody that trades in a printer, but for a more recent model. Your usage will remain unchanged, but the old and new printers use different cartridges. So we want to say whether each of the following is relevant or irrelevant. The price of the new printer, that's relevant, because if I don't trade it in, then I don't incur that cost, but if I do trade it in, then I will incur that cost. However, the price paid for the old printer is not relevant because that is a sunk cost. Whether I keep this one or trade it in, that does not change what I paid for the old one, however many years ago. The trade-in value of the new one is relevant if it reduces your cost of the new printer. The paper cost is not relevant because that does not differ. Whether I keep the same printer or whether I trade it in on a new one, I have the same paper cost. But the ink cartridges is going to be relevant because that does differ among my choices. All right, so we're going to talk about three different types of decisions, short-term decisions that we see. And the first one is a pricing decision. So when we set a price for a product, we have to ask ourselves, first of all, what is the target profit? Sometimes this is dictated to us. Our investors expect a certain return on investment. Sometimes this is just our personal goal. But it's not just about what we want to make out of this, right? It's also what customers are willing to pay. And the amount that customers are willing to pay depends on a lot of things. And this is if you've had econ or if you've had marketing, these kind of all come in there. What kind of value are you providing? Are there substitutes for your product? These types of things all pull in, like the elasticity. Is it a necessity or a luxury? If there's substitutes, then people probably aren't willing to pay as much, but if you don't have a substitute, you have more flexibility of the price. The market structure that you work in. So if you're a monopoly, whether they're an oligopoly, or if there's a lot of competition. So all these things will factor into what customers are willing to pay. So it's not just what you want to make as a profit, it's what customers are willing to pay for your product based on the value they think they're getting. So this will tell us, are you a price taker or a price setter? Well, there's basically three types of pricing strategies that we're going to look at. Target pricing and cost plus pricing. Oops. These are what I would do kind of for my regular business, my everyday pricing. But then we'll also look at special pricing decisions, like if it's a one-time special order or something like that. So we'll look at that as well. Okay, so target pricing, this is what's used by price takers, okay? For price takers, whereas the cost plus pricing is for price setters. Oops. Sorry about that. Sorry, dropped my pen. For price setters. Now, to understand this, we want to first look at the full product cost is a term that we will use a lot in here. So the full product cost is simply all the variable costs plus all the fixed costs. So if we're talking full product cost, and this is what we again use for our regular business, we want to build in, make sure we've built in enough in our price to cover our fixed costs in our regular business. So for target pricing, you basically set a goal. Oops. You set a goal for the full product cost. I want my cost to come within this certain range. So you're not setting a goal for the price, you're setting a goal for the cost, what it costs you to produce it. So you're a price taker. You have to kind of charge whatever the market price is charging. So you figure out what your revenue would be at that market price. That's kind of your given. This is the most I can make. I can't charge more. This is the most revenue I can make. You subtract off what you want to earn or what you need to earn as a profit. And then the difference gives you your target full product cost. You have to find a way then to make the product for this cost or less. So you start with the revenue, you subtract off the profit, and what's left is the price. You need to find a way to reduce your cost to that. For price setters, you take the full product cost. Here's how much it cost me to make my product. You add in the profit that you want to make, and that determines the price that you charge to customers. So the desired profit is kind of your markup, and then that determines the price that you charge to your customers. Okay, let's do a couple problems where we see these. I think I have one of each here. Oh, sorry, special pricing. Gotta talk about special pricing. For special pricing, it's a little bit different here. You don't always have to work in your full product cost for these guys. So this will be like if you have a special order, like it's a one-time order, something like that. So what you want to consider are, do you have excess capacity? If not, if you're running at full capacity, then this would mean that you would have to turn down regular business in order to take this order. And you're counting on that regular business to cover your costs. So if you don't have excess capacity, you'd want to charge full product cost for this. However, if you have excess capacity and your regular business is covering all your fixed costs, then you really just need to cover the extra cost that you would incur with this order. So you would just need to make sure the selling price is greater than what we'll call the differential cost, the cost that would be incurred with this order. differential costs. So the extra costs with this job. If I take this job, how much would my cost go up? Is what we mean there. So that's going to be your variable cost plus any incremental or any new fixed costs. That will be my differential. And remember, so if you don't have any incremental fixed costs, if you don't have any additional fixed costs, then it's really just as long as your selling price is greater than your variable cost. And if you remember, selling price minus variable cost equals contribution. If you do have incremental fixed costs, then for this order, you could just say, okay, the incremental fixed costs over the contribution would tell me the number I have to sell to break even on this order. The other thing you need to consider is taking this order going to affect your regular business? What if I sell on the special order lower because I'm not including the fixed costs, and then my regular customers find out that I sold to somebody else for cheaper? Or what if I sell it, I base this on a one-time order, and then they're like, wow, we were really pleased. We want to make this an ongoing business, an ongoing relationship. And then you're like, okay, well, now it's going to cost you $30 more. And they're like, well, wait a minute. So if there's a chance that this could become an ongoing order, you'd need to factor that in here as well. Maybe bill a little extra in the cost. Because if it's going to become part of your regular business, it has to carry its weight in contributing to those fixed costs. But if it's not going to and you've got excess capacity, you might as well take whatever revenue you can get. Okay, so this is Mountain Run operates Rocky Mountain Ski Resorts. The company is planning a lift ticket price for the coming season. The investors would like to earn a 12% return on the company's investment of $111 million in assets. So let's do that one right there. That's our target profit right there. So if we take 111 million in assets times a 12% return, that gives us 13,320. That's my target profit. The company primarily incurs fixed costs to groom the runs and operate the lifts. Their fixed costs are $37 million. They serve about 680,000 skiers. Variable costs are $8 a guest. Currently, they have such a favorable reputation among skiers and snowboarders that it has some control over the lift price. So would they want to use target or cost plus? And the answer to this one is that they would want to use the cost plus because they have some control over the price here, right? So they would want to use cost plus because they are a price setter. This some control over the lift prices is kind of important there. So if they're going to use cost plus, they would just figure out their full product cost, add that target profit, and that tells us how much they're going to charge their guests. So their variable costs would be $8 a guest, and they have 680,000 guests. So their variable costs are $5,440,000. Their fixed costs, they told us, were $37 million. So that means their full product costs are those two together. So that's $42,440. We add in our target profit, or our desired profit, which is the 13,200 that I figured up here, or 13,320, sorry. So that means the target revenue, I need my total revenue to be $55,760. If I divide that by the number of guests, what did I say, 680,000 guests, that means I'm going to charge $82 per guest. If other resorts in the area are charging $80 a day, we're going to charge $82. That seems reasonable. So just because you're a price setter doesn't mean you have absolute control. If everybody else is charging $80 and we came up with a number of $150, that's probably not going to be reasonable, because I don't think people are going to pay twice as much to come to our ski resort. But $2 extra, based on how favorable our reputation is, that's probably going to work. So we still need to keep it in perspective there. We can't just charge anything we want. The second one says we're going to use that same information there, but we're going to assume that our reputation has diminished and other resorts are still charging $80. We have become a price taker, which means we have to use target costing. We will not be able to charge more than $80. If they cannot reduce their cost, what profit will they earn? So I'm going to do this one on this slide, and I'm going to do this one on the next slide. So if they earn revenue, of $80 a customer times 680,000 customers, it means my total revenue will be $54.4. My product cost, I'm just going to pull that from the last slide because we already figured that out right here, right? So that's the $42,440, and that hasn't changed. Minus $42,440. Oh, I think I missed a couple zeros there. There. So that means my profit, if I can only charge $80, will be $11,960. Will they they want this also as a percent of assets. So we would divide that by the assets, divided by 111 million in assets, gives us a 10.77% return on assets. Will the investors be happy with that? No, they will not be happy. They want a 12% return, and we're giving them less than 11, so they will not be happy. The second part says, I'm doing this one now, assume that they found a way to cut their fixed costs. What is their new target variable cost per skier or snowboarder? So now we're doing the target plus the target pricing. So if we remember our other stuff, see the revenue is given, right? $80 a person times 680,000 people. So my revenue is the 54.4. Then I subtract off my target profit, and that was the 111 million times 12%. So that was the 13,320. So I subtract that off, and that means I need my full cost. So my target for my full cost is 41,080. And I know that I've got my fixed cost down to here. So minus my fixed costs, 36,320. I don't know why this tablet does that. That means my target then for my variable cost is 4,760,000. If I divide that by the number of guests, I get $7 per guest. That's my target variable cost. So that means even if I found a way to cut my fixed cost down to this, I still need to get my variable cost down to $7 a guest if I'm going to give my investors their 12% return. Now the other thing to consider, which they don't really put in here, but the thing to consider is, okay, I've cut my fixed costs and I'm cutting my variable costs. So I'm buying, I don't know, cheaper food, cheaper wax. This could mean I'm not maintaining the runs as much or something like that. So can I cut my cost by this much and still get my 680,000 skiers? Because it's very possible if I'm cutting my cost that much that I'm compromising the quality and I could lose business. So the real question is not just can you cut your cost that much, can you cut your cost by this much without affecting the quality of your service? Because if that's the case, you're going to lose sales as well, which means you're still not going to hit your 12% in there. So you have to find a way to do this without compromising too much, or you still won't hit your goal. So that's target pricing. Let's do one with a special pricing decision. Okay, so I'm not sure, this might be in your demo problems, it might not, but I just wanted you to see a special because I know they're in the homework. Suppose that the Baseball Hall of Fame in Cooperstown has approached Hungry Cards with a special order. They want to purchase 55,000 baseball cards for a special promo. They're offering you 33 cents a pack. Their total product cost is 53 cents a pack. So at first you're like, I'm losing 20 cents a pack, I'm not going to do it. We do have excess capacity. Prepare a differential analysis to determine whether they should accept it. So if I accept this order, I'm going to get an extra, let's see, my revenue will increase. My revenue will go up by 33 cents a pack times 55,000 packs. Oops, an extra zero there. So my revenue is going to go up by that 18,150 that they put up here. How much are my costs going to go up? Well, my direct materials, I'll have to incur that, direct labor, and variable overhead. But I'm not going to incur any additional fixed costs because of this job. So that one's not relevant. I don't want to use the full product in this cost because my regular business has taken that. That 25 cents was built on my regular business. My fixed costs aren't going to go up, so I'm not going to incur any additional fixed costs. So the only additional costs I will incur will be these three right here, which come out to 28 cents. So my cost will go up by 28 cents. So my costs go up by 15,400. So my revenue is going to go up by my cost. So that means if I take this order, that will increase my operating income or my profit by 27.50. So I should accept that order. The second part of that says, now what if they want this special hologram that's going to cost $5,000? That's going to be a fixed cost. Now you can see right here, if I'm only making $27.50 and you add another $5,000 in cost, this is clearly not going to pay for itself. But let's look at it this way. My revenue will go up by the 18,150. My variable costs will go up by the 15,400. And my fixed costs will go up by 5,000. So that means if I accept this order, my costs are more than my revenue by $22.50. So I would lose $22.50. My income would go down. So I should not accept that. However, now they don't ask you this in the problem, but we could look at this too. We could look at this a couple of different ways. We could say, because generally with this type of thing, there is some negotiating. I can't do it for 33 cents a pack, but how much could I do it for? So you could take your full product cost. This would be just cost plus pricing, right? So I take the 15,400 variable cost plus the 5,000 fixed costs, and say my full product cost is 20,400. Let's say I want to earn a $2,000 profit. I'm just making that up. So that means I need this to be 22.4. I would just divide that then by the quantity. I need to earn 22,400 on 55,000 baseball cards. So that means I need to, if you rounded that up, I can't do it for 33 cents, but I can do it for 41 cents per pack. Or the other thing is you could just take your full product cost here, divided by 55,000, and that tells you your kind of break-even price. I can't, and so that gives you your negotiating room. I didn't figure that out, but let's say it's 38 cents or whatever. Then that says, you could offer that tells you how much negotiating room you have. The other way you could do it is sometimes it's the volume, so you could do just a little break even. $5,000 is my incremental fixed costs. My unit contribution, the selling price is 33. The variable cost we said is 28. So the unit contribution is 5 cents. So if I divide my incremental costs by the 5 cents, I get 100,000 packs. So if this is your order, you could say, okay, I can't do it for that. However, I could do it for 40 cents a pack or 41 cents a pack. Or at the 33 cents a pack, I can't do it for 55, but if you up your volume to 120 or 150,000 packs, then I can do it. So a couple different ways that you could counter offer to make this profitable. And again, a lot of that would depend on whether there's other companies that could do this or whether you're the only one, that kind of thing. Okay, I think I'm going to pause this here and then do a second video for the other two types of decisions we have.